Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront and generate consistent returns year on year. So the first thing that we want to do is open up any equities underlying in our brokerage platform, and then you want to navigate over to where you can see a list of expirations for that underlying, that's the watch list. And we want to lock in on a expiration date that we can use to mock up positions moving forwards. Now, the expiration date that we need to choose needs to be between 30 and 60 days out in time, and it also needs to be a monthly, not a weekly or quarterly expiration. The only expiration date that currently fits that criteria is January 17th, with 35 days left to go. So we can take that information, come over to our watch list, and simply filter out any and all underlyings that have an earnings announcement over the next 35 days. And we can also filter out anything that has a low liquidity level. So what that means is we're not going to have earnings disturb our trade, and we're only going to be trading liquid markets. That's going to mean that volatility has a higher chance of working in our favor. The deltas aren't just going to be messed up by some random earnings announcement. We're going to be paying tight spreads, and it's going to be fairly easy to get in and out of these positions. So that's why we make those. That's why we do those things on the filters. Now, I personally like to order everything from high to low IVR, which is IV rank. Reason for that is because we want to sell when volatility is high. And when I say sell, I don't mean sell the actual underlying. I mean sell the contracts on the underlying. We want to sell the contracts when volatility is high and play the contraction and get out of the position, or buy it back, or let it expire worthless, or whatever. But the point is, we want to let volatility contract. So we want to sell it when it's high, let it contract. And why do we do this? Because volatility is mean reverting. So when you sell it when it's high, it has a higher chance of it going down. So at this point, we just go down the list. You can use any watch list you like. It's just a pre-made watch list. And you want to just go down the list and see what would fit well in your portfolio. Make sure everything is nice and diverse. Use common sense, and you'll be absolutely fine over the long term. First thing that comes to mind is mRNA, but we had a look at that yesterday, and the strike selection for mRNA wasn't the best. We've got HIG, or the Hartford Financial Services Group, with an IV rank of 71.3, an absolute IV level of 26. Let's just have a look at the chart. We don't trade based on the chart. We don't look at the chart, but by all means, just to give you some context, it can be used. So let's have a look and see if we can mock up a decent position on HIG. So we want to pick strikes between 15 and 20 deltas. And we've got a 19 delta here at the 120 strike on the call side. And on the put side, we've got a 17 delta at the 105. Now, for the more astute viewers out there, you will have noticed something. That the 120 strike, this contract here, the bid is at 0.65 and the ask is at $1. This is very wide. Now, although we did make the filters, we did do the filters to filter out low liquidity things. We do need to also make sure that we are manually checking the bid ask spread as well. That will filter out most things, but some things will slip through. Now, if you look on the put side, you got 0.7 and 0.9, right? 70 cents and 90 cents. This is very wide. This is too wide. So we don't want to trade this. You're going to be paying, basically every time you get in and out, you're basically going to be paying the spread. So you're paying 35 cents every time you get in and out. So that's 70 cents you pay on a round trip. And then you have your normal commissions and stuff. So we don't want to do that. And just to put into perspective, let's say we take a SPY, right? And same expiration date. I mean, when it decides to load, if you look here, the spreads are now 1 or 2 pennies wide max. Even if you go further out, you go to a 20 delta, you're still 1 or 2 pennies wide. This is an example of what it should look like, what you want it to look like. But yeah, back to what we were doing. HIG, we're going to give it a miss. UAL it's currently trading at just over $95. It's had a very big run up from about $40 to just over 100, touched just over 100, and now I think the stock is going to be taking a bit of a breather moving forwards. If we have a look here, as you can see, from around $30-40, it's had a very big run up with pretty much no pullbacks. It's hit all-time highs at about $100. If we just go back in time a little bit, let's say we just go on the weekly, go back 10 years. As you can see here, I'm not going to keep going back, but, we're at all-time highs pretty much. And let's just go back. So, if you wanted to take the contrarian approach, now would be a pretty decent time to, maybe sell some calls or some call spreads or whatever. Again, if anybody has read the book Random Walk Down Wall Street, you'll know that it doesn't really mean too much. It's 50-50. Any given time, where the market's going to go, it's 50-50 in the short term. Long term, 6-12 months out, 3 to 12 months out, even, you can predict direction. Not by looking at charts, of course, but some people might be able to, fair play to them, but that's not how I predict future. We look at certain reports and things like that. We look at forward leading indicators, and we're going to touch on that a little bit later on. But UAL, right? Let's have a look at UAL. IV rank of just under 69, absolute IV level of 49.6. Everything looks good. We should be able to get some nice strikes, or there should be some decent strike selection here. We've got a 21 delta on the call side, and on the put side, we've got a 21 delta as well. The bid-ask spread is a little bit wide, but it's okay. This is kind of in the okay-ish zone. It's not the best, it's not the worst. Use discretion. Obviously, if there are better positions out there, if there are better opportunities out there that you can spot, by all means go for those. But this isn't too bad. It's not the best, but it's not the worst. But we're going to carry on anyway. So we've essentially created a range for ourselves between 85 and 110. As long as price stays within this range at expiration, which is in 35 days' time, we keep 100% of the premium that we collect up front, which is $3.64 times by a contract multiplier of 100, which is $364. That's what we collect up front. And our broker is going to hold just over $950 in buying power to open this position. Now, this is a very nice return on capital, especially with it being a naked position, which is why you may want to overlook the spread being slightly wide, because the return is so nice and juicy. And we've got a 69% chance, probability of profit even, which is the chance of making at least 1 penny by expiration. And if we want to get out of this position at 50% of max profit, we've got an 81% chance of that happening at some point between now and the next 35 days. So very, very high probabilities of success. However, $954 might be too much for some people. So what we will do is simply buy a contract a little bit further out, $5 wide, and we can do the same thing, $5 wide on the put side. And we've essentially created a range for ourselves here. And what that's going to do is limit our loss. We've defined our loss to whatever the spread is, which is $5 minus the premium that we collect up front. And that's times by the contract multiplier. That's what our max loss is. Contract multiplier for equities is always 100. For futures, it varies. It can be in the hundreds of thousands. But that's what our max loss is now. It's no longer unlimited. It was unlimited before, as you can see, but now it is no longer unlimited. And our broker knows what our max loss is, so it only needs to hold that much in buying power. And as you can see here, generally speaking, the return on capital is higher with a covered position like this. However, because the naked position had such a nice return anyway, you might want to just run the naked position, assuming you can afford that much buying power to one position. So in return, in exchange for this even, our probabilities of success do suffer slightly, and that is the trade-off. You get nothing for free in the market. the market is priced very efficiently. Now, how do you know how much buying power you should be allocating to your positions? Well, in order to figure that out, we've created a free position sizing template. The link will be in the description. And the way it works is you enter in the size of your portfolio. Let's say you have $10,000. And then below that, you then enter in whatever the current VIX level is. Let's just say if it's 25. It's not 25. I wish it was, but there you go. Everything below will then be automatically calculated for you. And all you need to do at this point is simply use this information to form the backbone of your portfolio. It will tell you how much buying power to allocate to any single defined risk position, undefined risk position, how much of your portfolio you should be allocating to short premium strategies in general. For example, if you have $10,000 in your account, you should never be allocating all $10,000 to writing contracts. That would just be silly. So as long as you stick to this, you'll be fine over the long term. If you want to learn in more detail about what we do, how we do it, again, link in the description. This time, click on EDS Premium. Inside, you will have access to our portfolios that will allow you to see in real time the positions that we're placing, how we're managing risk, the adjustments that we're making, etc. You can use those positions as inspiration, or you can simply just copy us. It's completely up to you. There is a full course inside where we teach you everything that you need to know from start to finish, not just about how to write contracts, but also about how to predict market direction by looking at actual real leading indicators that hedge funds look at, investment banks look at. Not throwing shade on anyone, but we don't base it on charts and looking at basically anything on a chart is past data. You're looking at past data to try and predict the future. If that works for some people, fine, great, more power to them. But that's not what we do. We look at forward leading indicators that can predict market direction, between 3 and 12 months out in time, or 6 and 12 months out in time. So everything that you need to know is in that course. Now, it is a private community, so if you get stuck at any point, you can speak with myself directly. You can ask questions in the groups and speak with other like-minded individuals. And there is also a 100% money-back guarantee. So once you have studied our full course and followed our trades for at least 6 months, if you haven't seen results, then we will work with you for free until you do. Or you can simply request a full refund. So it's 100% risk-free. And right now it is £1 a month to join. The price will be increasing. However, once you're in, the price is locked in for life. So you are definitely rewarded for getting in early. And with that being said, I will see you guys on the inside.